Hi and welcome back to Cheeky Crypto. My name is Nick and today guys we're going to be jumping down into the world of Bitcoin, specifically taking a look at the macro picture, anything from the daily charts and above. As I get into this video, if you find it useful and informative, smash that like button, really do appreciate that. If you're new to the channel, why not consider subscribing, staying up to date with all the videos that we do here at Cheeky Crypto. And if you haven't yet joined us in Discord guys, check it out, linked in the description down below. It's a fantastic community talking crypto 24/7, it's completely free and I don't think you'll be disappointed by what you find down there, so why not go ahead and check it out. Let's make a start with this one though. We'll try to keep it nice and brief. Over the weekend there isn't terribly too much going on in terms of price action, but there are a few things that are being set up here on these daily timeframes that's probably worth noting about. So what we'll do is we'll start things off just by reviewing where we are on our Elliott Wave theory, jump into our smart money concepts, and then take a look at some macro trend lines and things like that. So up here on an Elliott Wave theory side of things, we are still in play for the Z wave. However, we are pushing up higher, which the higher the move goes here, the worse, or sorry, the lesser pain there's going to be on the Z wave structure. But there is another potential option that is more bearish, and it's not one that we'd like to kind of discuss until we cross that kind of $32,900 level. And that is that we are in a bearish situation for a bigger macro. Where if that X wave crosses here, it's no longer really an X wave, right? So we'd kind of park that idea and take that off, and all you've got here is this bigger corrective structure coming up, and that could lead us into a very, very big bearish three-wave drop, taking us down significantly lower than we would like it to go. And so it's almost like you're better off with the Z-wave structure than you are trying to do the other one. But there's a lot of FOMO, a lot of people believing that lower lows just simply aren't going to happen. But again, the underpinned data as to why you cannot have a bullish market right now still remains the same. The broader economic climate at a macro level is incredibly bearish. You cannot be bullish when you actually take stock of what is going on around the world. And then, of course, you underpin that with who is buying, who is selling, the fact that large institutional investors are not coming into the space, they're coming out of the space. And it's important that you don't just cut the data or see people cutting the data to try to suit it, to suit a bullish narrative, when actually the data is very, very bearish in an uncut way, right? If you just look at it as it is, and yeah, it's one of those. It's an interesting time. But ultimately, I much prefer the Z-wave structure than I would to see a ABC structure. Either way, I do think we have to come down. Now, the Z-wave structure is nicer because it means you don't have to have new lower lows. You just have to go down deeper. I still suspect, however, that we will have new lower lows because it doesn't make sense that institutional investors were coming out at the very bottom of November only to then buy up cheaper. It doesn't matter. It makes sense to kind of see these smart funds coming out of their positions here only to come in higher, right? That's a retail thing. Retail do those things, not institutional level whale investors. So understanding the differences are very, very important. Now we have, of course, moved up higher, so we can go ahead and check our recent moves here on this Z-wave structure. Okay, and we can go ahead and pull this over to where we currently sit, which is over here. So I'll go ahead and just pull that onto this line right there. Yep, that's good. Okay, that basically now means that we can adjust our range down here just a fraction. It's basically going to be on the low side 11,695 and on the high side 18,474. And an $18,000 Bitcoin would be very, very nice because that does tie in with smart money concepts. So as we kind of transition from Elliott Wave theory over into the smart money concepts, we can acknowledge that we have these fair value gaps that are left behind. These fair value gaps are created from imbalances in the order books. Essentially, if a buyer comes along and wants to buy a lot of Bitcoin at a very specific price down here at, let's say, $20,000, and there's not enough liquidity or enough people selling Bitcoin to them in order for them to actually fill their orders, the price jumps from the low side to the high side, and this gap gets left behind. This gap, they call it a fair value gap, they call it imbalances in the order books. Essentially, these gaps, they're an indication that a big fund has come in here and tried to push the price in a direction. This is why smart money concepts is really important. Now, when you see these things, Normally what would happen is you'd have one of these gaps, right? And under normal circumstances, without manipulation, what would happen would be that a smart fund would come in here, try to place their order, let's say at $19,000 down here. Okay, they'll then the price will jump up here. They won't continue buying because they wanted to buy it at $19,000. They don't want to be buying it at $20,000, right? But price goes up to $20,000. What do? They don't continue buying, they wait for price to come back down. Naturally, price gravitates back down towards these liquidity zones. These, no, they're not zones, they are fair value gaps, right? So price loves to come back down to where the imbalance was, and the whales and the institutional funds can continue buying, right? And they can manipulate that price. Now, what we're seeing here is very clearly manipulation when we see them stacking up these gaps, right? These gaps, they're not really designed to be stacked like this. It says, basically, if we were to follow that logic, whales and institutional investors came in here, bought at $19,000, and we don't need price to go back down. We'll buy again, right? And then they're buying at $20,000. They're buying at $22,000. They're buying at $25,000. And in reality, what is actually going on here is they're pushing the price to the upside. And that is clear manipulation, because that's not how you would logically approach the market. If you're trying to get the most bang for your buck here, you're buying a significant volume of Bitcoin, you're going to want to have pockets of liquidity to buy into. And all they're doing here is they're creating this kind of FOMO area, not, I don't think, to be buying up Bitcoin, but to sell Bitcoin at a later date. I think they're creating pockets of liquidity around the FOMO so that they can offload a significant amount of Bitcoin at a slightly inflated price. And then, of course, what will happen is price will come on down. So to me, this looks like pretty clear manipulation. Now, we do also see that we had this bullish change of characterization, okay? And when we see these, we typically do see retracements from these as well, okay? Even without breaking our structure. So we create this change of character from bearish to bullish, okay? And normally you come down and you basically just naturally kind of fill it out. We haven't done that part yet. Okay, so naturally, once you have this change of character, we cool off, we come back down, profits get taken. You can stay in your bullish structure here, and then we move back up again. Alternatively, we can go down and break that structure, because I don't think it's really driven from real orders or anything like that. It's just clear manipulation. So what do we see here? Well, we can see that Elliott wave theory wants to go down. We want to see price action down on Elliott wave theory, right? There's no impulsive structure, right? I know a lot of people who don't fully understand the rules of Elliott wave theory are saying, look, 1, 2, 3, 4, 5, we're going to the moon, right? And it suits their narrative. It gets them the clicks and all that, but it's not really what's going on. We've been through this a dozen times. You don't have the right structure at the beginning, so everything after it has to be corrective. And smart money concept shows us the clear manipulation of what is going on. And these two things coupled together, if we can take a look at it from a narrative that, the market is being pushed in an upward directional move, mainly by market makers and large institutional funds, then we can acknowledge that actually, yeah, there's going to be a natural move to the downside. Elliott wave theory has the big concern of a bigger corrective structure that takes us down sub 10K, but that's really only something that we can kind of confirm as a possibility when we cross the $32,000 or $33,000 level, okay? Now, when we take a look at our trend line structures and our resistances and things like that, we're right up in our supply zone. Up here, we're testing the upper area on our trend line, of which, higher highs and higher lows have a tendency to break down. We can see that. We can also see that on, if I come into here, we can see that right in here as well. On our daily chart, we've got a little mini version of this going on. If I grab hold of my parallel channel right here, okay, we can kind of acknowledge that right inside here, we also have a very similar situation occurring. Could probably go on for a little bit longer if it needed to, but you can kind of see in here we have the higher highs, and we actually had to set this lower low for a moment there, but you can kind of see how this particular situation is not overly giving me a lot of confidence anyway in the space. And we can see this on a much bigger scale here. You can see in this bear market, every time that we do this, we come down quite heavily. Whereas in a bullish market, it's the other way around, right? These are more bull flag situations, right? Where they tilt down and they break upwards. And when you see them tilting up, these are more bearish situations where you see them coming on down. And we can argue that this is one of the biggest bull traps of all time for Bitcoin here, because we could argue that this is a big corrective structure. This is the big worry, right? We have this kind of big corrective structure taking us down. And that it's a big bear flag, right? And it's one of those things that not a lot of people are paying attention to the macro stuff and not paying attention to what is going on at a macro level, right? They're just jumping on, what looks bullish to them, higher highs, higher lows, and all that nonsense. But for me, it looks like we have to go down, right? And $18,000 is a nice area to be targeting. I think that's a nice range. But I suspect new lower lows are required if we want to see institutional investors and whale players actually coming into the space. At the moment, the majority of the accumulation that has occurred over the last 6 to 12 months is retail money. And I don't think retail are going to be able to hold out terribly much more. So let me know what your thoughts are on all of this in the comment section down below. If you found this useful, informative, maybe even entertaining at times, why not smash that like button? I really do appreciate that. If you're new to the channel, why not go ahead and subscribe, tap in the bell, selecting all the notifications, and you will not miss another video. Guys, until the next one, have a fantastic day.
We are not financial advisors. None of what we have communicated verbally or in writing here should be considered as financial advice. It is not. Do your own research before investing in any digital asset or affiliate offers, and understand that investing in any crypto is risky. If you do, you need to be prepared to risk your entire investment. This video is for information and entertainment purposes only. All our videos are strictly personal opinions. Please make sure you do your own research and never take our opinions for financial guidance. There are multiple strategies, and not all strategies fit all people. Our videos are not financial advice.